Lori, I think maybe it makes sense to just say exactly what you think is at stake for the markets for this weekend and how the impact is going to manifest markets. Are we going to be looking to the dollar, economic growth estimates, some other factors that would be the transmission mechanism from what happens in Buenos Aires to financial markets?
Well, there's a lot at stake, and the big eyes are going to be on Trump and Xi and what happens in terms of U.S.-China relations, because that's the one that matters the most in here. If we get a full-on trade war, there are some estimates that suggest that that could take 1% off of global GDP and as much as 2% off of GDP in China and the U.S. And at this stage in the market cycle, that would be quite challenging for markets to navigate.
Peter, where do you think the markets are set up with expectations, not just for this meeting, but just into year end? It's interesting. I almost wonder if the outcome is going to be kind of a Rorschach test. If the market rallies on it, it will have found some excuse in the agreement or in the lack of an agreement to rally. If not, the market was probably a little bit overstressed anyway.
Yeah, I love that. I love the Rorschach analogy. That's great. Look, our view has been that the markets were a little bit oversold here, the equity markets in particular. We did finally get a reaction from the high-yield credit market with high-yield spreads moving above 400 briefly. But the markets were oversold, and the sort of walk back from Chairman Powell at the economic meeting in New York catalyzed what we thought was likely a rally into year-end anyway. And with respect to the G20, yes, it is important. And by the way, I think we are already embroiled in a global trade war here. So I think that it's going to be an extend and amend from the standpoint of President Trump and President Xi into the spring. And as a result of that, I think that helps to provide additional tailwinds to a market that was already poised for a bounce.
Lori, given all the questions, the uncertainties, the unknowns, whether it's this weekend or some of the other big things that investors are looking at right now, how should they be positioned in this market?
Yeah, so we're actually still pretty positive on equities. We think the fundamentals, particularly in the U.S., warrant an overallocation to equities. We do think that there will remain geopolitical risks. I mean, certainly trade is one, but Brexit, other things happening around the world are going to be flashpoints. So investors should be looking a bit defensively, and we think the U.S. is a pretty good risk reward in that regard.
Peter, defensiveness actually has been the tone of the markets for months now, even on these rebounds. And I wonder if there's any way to characterize just whether investors are too focused on the prospects for the end of a cycle into next year, or if that's just the appropriate place we're in right now. I'm really thinking back to a year ago when the consensus was global synchronized growth. Right. Maybe the U.S. was going to have too much momentum, and it didn't exactly work out that way.
No, it didn't. And, you and I have talked about this in the past. I mean, my big concern was rate volatility and tighter global financial conditions. Really from the get-go, albeit came into the year bullish, I think it's an appropriate concern to worry about 2019. And frankly, for 2019, as our outlook for next year evolves, we're becoming more and more cautious. There are a number of cracks. Higher rates in the U.S. have led to real slowdowns in emerging markets. That is very important to global growth and will eventually circle back to the United States. We're seeing a slowdown in the housing market here. And again, we're finally starting to see support from the credit market start to go away. And by the way, there's a lot of leverage in the system right now, both in low-rated IG, but also in speculative loans. The LBO market is on fire. So all the sort of red flags that one needs to be concerned about are starting to pop up right and left here.
Lori, I want to dig into some notes I see here from you. You say, trade wars aside, 2019 will be a momentous year for China. Why?
Well, it's going to be a big transitional year because we're going to, first of all, have additional, hopefully, discussions on trade and come to something that's a little bit long-term sustainable there. They continue to have to transition from more of an investment-led to more consumption-led economy, and that seems to be happening, and we hope to see that accelerate in 2019. But we also are going to start to see Chinese securities become a much more prominent part of major indices. And so investors globally are going to have to think about how they integrate Chinese debt and equity into their portfolios.
And Peter, finally, this outlook for further financial tightening and maybe the risks becoming to the fore in 2019, did the Fed's approach change any of that, or could a prolonged Fed pause change that picture?
Yes, well, one's view cannot be static. It has to be dynamic. Central banks will obviously react to the risks as they begin to identify them. In fact, the Fed did identify the BBB risk in its financial stability report. So the Fed and other central banks will react. And yes, I think there was a real walk back from Chairman Powell talking about a cycle that could extend indefinitely, from being a long way from neutral to just under neutral. So I think the Fed is ready, willing, and able to be a little bit more accommodative relative to its path from a couple of months ago. And that could affect my view, making me a little bit less cautious. But unfortunately, I think the writing is a bit on the wall already because financial conditions globally have tightened considerably. And in fact, my eye is really towards the ECB in mid-December with respect to whether or not they actually extend ECB the way they did in September, because I think that's the marginal provider of liquidity.